So Terry, here we are with the Me the Money show, first one in the series, and we're going to talk today about liquidity in the market, about where spreads are in the market, and give some of the traders out there an idea of what's been going on, perhaps outside of their sector and hopefully in their sector too. The first thing I wanted to talk about today was really trading volumes and what that means for liquidity. We've seen an enormous number of moves in the equity market towards lit order books. Particularly, we've seen data from Big XYT looking at the European market, and they've seen the exchanges taking a quite a significant amount more order flow than they typically would. So the lit markets at the moment are around 53% of order flow. They were at 43% in February 2020, just prior to the 24th, when things really kicked off. And if you look at March last year, they were around 45%. So between 8 and 10% greater than we might typically expect in the lit markets. Closing auction in Europe as well has dropped off a lot, so it's now around 11% of the market. It was around 14% back in February, and last year in March it was around 15%. So some decline there, which suggests to me that people actually want to see immediacy of orders being filled and certainty that orders are being filled, rather than people putting orders into the book passively and waiting for price improvement. What's your view on the liquidity picture at the moment?
Right. The numbers that we've certainly have seen the same trend in the U.S. that you're seeing in Europe. It does seem to be less of the case. Like, for example, I look back at the numbers off the NASDAQ site, and it looks like off-exchange trading before the 10-day period before the volatility started around February 19th, off-exchange trading was about 37.5%.
Yep.
More recently, in the most recent 10-day period I looked as of yesterday, that was 34% off-exchange trading. So definitely some movement toward the lit market, but not as pronounced as the numbers that you seem to be seeing in Europe. I did speak with a market expert yesterday, and the conversation, what we talked about is the reason for this is because dark pools and off-exchange trading have proven themselves in times of volatility. Where they don't do so well is when there's a breakdown specifically in market structure. For example, flash crash, night capital, things like that. I look back and there was something reported even after the Michael Lewis book, Flash Boys, in 2014. Off-exchange trading went down in a month 13 percentage points. That is a really big move. So that's about 4 times the move we have seen recently. So there is more exchange trading, less off-exchange trading, but it's not quite as dramatic a move as you might expect.
Sure. And then in the fixed income markets, we've seen volumes increase massively as well. What's interesting, of course, about fixed income is that without the centralized structure that you have in the equity market, it's much harder to pin down exactly where trading is taking place, typically. But we can see, certainly in the US, we've got trades following the order flow there. Europe doesn't have an equivalent. But if we look at the US market, on the 24th of March, trading volume was around 19 billion for dealer buying from clients, and then dealer selling to client was around 14 billion. If we look at the 24th of February this year as well, so just a month before that, dealers buying from customers around 6 billion, and dealer selling to customer was around 7 billion. So the volumes have changed significantly in that period. Of course, these are the volumes. You'll see in Treasury trading as well. Treasury trading was 2.4 trillion on the week of the 2nd of March, and the week of 13th of March, it's 2.1 trillion. So volumes are massive, both in the corporate bond and the government bond markets. But volume doesn't equal liquidity. And so, of course, if we look at the direction of where people are trading at the moment, EPFR, which is an Informa Group company, they have been looking at the outflows from funds, and outflows from bond funds in the week of the 20th was around $108 billion. Outflows from equity funds that week was 20.6 billion. So, of course, that means that for all this volume, it's all going in one direction. And if you're trading, that doesn't necessarily mean you can find someone on the other side of your trade. So for all the all the money that the intermediaries are making, if you're a buy side trader right now, things are pretty difficult to execute, I would have thought. Have you got any thoughts on the liquidity picture there?
Yeah, and fixed income treasuries, what I'm hearing and what I'm seeing is that the on the runs are pretty liquid, and there's a lot of volatility. Hearing anecdotal reports of yields on benchmark notes moving 10 basis points in a minute, and we're seeing 50 basis point intraday moves. So it is very choppy, it is very volatile, but in general, hearing that the market is functioning well. What's functioning less well in treasuries is off-the-run treasuries, which are generally less liquid to begin with. They do comprise a larger notional part of the market. So when they're not liquid, that presents a problem to the overall market. You're hearing a lot of really big differences between spreads in yields in on the run and off the run that are usually tracked very closely together. That's causing some further market dislocation. And really, treasuries has been the epicenter of all of this market tumult, I think. And I think other markets trade off that, not just corporates, but also equities. And in the corporate bond side, we're seeing it's not quite as functioning as well as treasury markets, where we did see a good uptick in trading volume, both investment grade and high yield, around when this volatility started about a month ago. I think the numbers I have, investment grade went from about 20 billion a day trading to about 37.5. High yield went from 10 to 17.5 billion.
Yeah.
However, in more recently, over the last week to 10 days or so, that trading has kind of ticked off a bit in volume compared with a month ago, where other markets have gone higher volume. So the reason is that just the liquidity isn't quite there. It's more of a bifurcated market. There's fewer CUSIPs trading, so there's a fair liquidity in some of the big names. But if once you get outside the big names, it's questionable if you're going to find tight spreads, liquid markets. So that's where there's been some dislocation. The Fed has signaled they'll be buying corporate bonds. So I think that's seen as a help going forward, but we'll have to see how that plays out.
That's a very good point you made on the concentration there. If it's a higher volume, but actually there are fewer CUSIPs trading, then actually that means there's a greater concentration in a certain number of securities. That doesn't mean there's actually greater liquidity out there, even regardless of the direction of travel. On the point about pricing, we've seen some very interesting things around pricing. I mean, just looking at spreads for European government bonds at the moment, if we look at the 10-year, the spreads are all up between, or all up sort of at least double digit, in some cases triple digit, against the bonds, the German government bonds, according to data from MTS. But I think even if beyond the spreads, we look at some of the challenges around making prices right now. We've seen some amazing stories. I mean, the buy-side traders are telling us that screen prices are around 10% off where the bonds are actually trading at the moment, and that's creating enormous problems. We've seen some Nordic funds shutter themselves overnight so that they can go out to dealers to get prices for bonds, so that they can price their portfolios and work out the net asset value, which of course is needed for redemptions if people are withdrawing funds. So pricing at the moment is pretty much all over the place, and that's a real challenge for both buy-side traders and sell-side traders. I've also heard that spreads are wider in the mornings at the moment than they are in the evenings, because, of course, the sell-side are actually trying to work out where exactly they should be pricing. And so once they see the lie of the land with the market, they get a better idea of that. And so spreads tighten up during the day. But that's proving, I mean, it's a massive challenge for the market. And I think, I don't know if you have any sort of thoughts on either the spread market, or rather spreads at the moment, or pricing, but certainly I get the feeling that people are really struggling with this as an issue.
Yeah, certainly. Some of the work we're doing recently is on automation on the sell side, and you might think just hearing that those are the desks that go all algos, but really what the optimization endpoint is for automation on the sell side is automating the smaller trades, which might be 500,000, 1 million, up to 3-5 million. Automate those small trades, which frees up the trader bandwidth for the larger trades, the 10, 25 million, 50, higher than that, the large institutional trades that need some work, that need human a human touch. So, I think we're going to find when this when the smoke clears on this, I think the desks that have been first movers, that have solid automation suites in place, they're going to be the winners in order flow here, because they're the ones, when someone calls, they're going to be a buy side trader calls with a big trade. They're going to be the ones who have traders available to help them with that. Whereas the other ones that have sell side desks that haven't automated as well will still be having manpower, human power, work on those smaller trades. So we'll see how that shakes out.
Yeah, definitely. Actually, just on that point, we've got a story just that came out on Thursday, which is looking at portfolio trading. And this has been an interesting and positive story this year. We've seen a number of buy-side firms using portfolio trading to trade a list of securities all at the same time. And this can only be done, to your point, by sell-side firms who are able to price effectively and automate the trading on their sell-side desks. But those who can provide pricing for a whole list of securities that the buy-side trades, and that gives them that immediacy of execution, that certainty of execution that we were talking about at the start. So there's definitely certain trading protocols which are winning out in the current market and helping people out quite a lot. Just on that point around news stories, are there any news stories this week which are really that you really think we should bring to people's attention?
Yeah, a few things. Certainly, the New York Stock Exchange closing their floor due to COVID concerns, the first time ever. The COO had a good podcast on that last week, talking about what that means. Human traders are not just there for show or for CNBC interviews, but they do provide color. They do provide liquidity on some of the harder to trade complex trades, also at the open or at the close. Some of the other things we've seen reports of investment banks, the first quarter in the trading and markets revenue going to be up 20 or 30%. No surprise there. They've been busy, crazy busy with the volatility, which is good for them. Also, seeing some things, some regulatory things held up. For example, the broker order handling rules, that's going to provide a lot more information to the buy side as far as where and how their trades are routed. That's meant to go live April 1st. That's on hold. A number of regulatory initiatives are on hold, really. But really, overall, I'd say, in a sense, the biggest story from our seats might be the non-story of not having any breakdowns in market structure. Really, it's a little boring for news folks like us, but these exchanges and market venues are putting out releases saying all systems operational, record volumes, things like that. There's really, other than a couple retail type glitches, breakdowns, there hasn't been anything significant in the institutional market structure, which is kind of a non-story, but it's also a story in itself. What are you seeing in Europe on that, Dan, story-wise?
Well, I'd say, and this is actually a story both across Europe and the US, is really the issue around pricing is the one place things have broken down. So, I mean, if we look at the story that we broke on Thursday, which is that ICE data indices are postponing the rebalancing of their indexes in March, and they're pushing that back to April the 30th. So there's going to be a month in which the index is not rebalanced. That's a really interesting issue. I mean, if you're on the buy side and you've got funds which could have taken a loss in March and then rebounced in April, you're saving yourself all of those losses. You're saving yourself the trading costs. That's great for them. If you're a dealer, then you've got, that you're not having to sort of do these massive volumes of trades, but that's money in your pocket. So, perhaps not so positive for you. The question of the outcome of that is going to be interesting, because we've got to see whether or not in April things actually are better. I mean, we had, GM and Ford got downgraded. That's going to be included in the April change now, not in March. So making sort of postponing something like that is potentially risky, even though there might be some advantages. But if there was a month in which people were going to do it, this would be the month to do it. As one of my contacts said. So I think that's very interesting. But overall, the whole issue around being able to price in the market effectively, that's one area where things have broken down. It's been difficult for buy side, it's been difficult for sell side, and I think we need to see some sort of reform around whether it's market making improves due to changes in the capital rules and the leverage ratio the sell side firms are subject to, or whether there just needs to be better market data out there via some mechanism. But it's interesting all over, definitely.
All right.
Great, excellent.
All right, thank you, Dan.
Thanks, Terry. That's been fantastic.
Talk to you soon.
Speak soon.